Hey guys, how are you? This is Dave with Moniology and Markets. This is the weekend market review for the weekend of March 9th and 10th, 2019, where we take a look at stocks and equities and fixed income from a weekly perspective, trying to remove some of the short-term trading noise and give us a better understanding of what's taking place in the markets. So without further ado, let's take a look at some of the indices. Starting with the 10-year U.S. Treasury yield. And I've been very on point here in terms of this breakout here over the last couple of years. And we had a very nice run, kind of cup and handle pattern. But when I started noticing negative divergence, consecutive negative divergence, I did say that I think things are starting to reverse lower. And sure enough, we had a breakdown over here, and now we've consolidated a while, but now you've got the 50-week moving average rolling over. You had the symmetrical triangle, which was very interesting because I had a hunch we were going to break lower, and sure enough, we broke higher. And I thought, okay, here I was incorrect in my perspective, and then we had a fake out and now a breakdown. So I think we'll see 2.5 in yields sooner rather than later, possibly as low as 2.1. And if there is indeed a recession, I think we can go as low as, if you extend this trend line lower here, possibly about 1.5 on the 10-year Treasury. So more downside in the short run, next 1 to 2 years, than to the upside, in my opinion. You've got the Dow Jones Wilshire 2500 index, and what's unique about most of the equity indices you'll see here is most of them have had this bearish wedge. And so the question is here, what happens in this wedge? Do we break lower and basically create a new downtrend, or is this just going to break lower, expand this move and create a range, a positive range to the upside? Time will tell. The point is, when you're long here, this is the time to start cutting some of your long exposure or buying puts and protection here. But this looks to me like an inverse head and shoulder, so definitely something to keep an eye out. If this breaks below the 50, if it breaks below this trend line breakout, then that will be a very ominous sign for the markets. Here's gold. Gold, as pointed out in our PM video, is in an uptrend here. We had a bearish wedge that we broke down from, and now we've recovered, found support across this golden cross, where the 50 crosses the 200, and now it looks like we're on our way towards that 1380 area. And as most people have correctly said, you break above 1350, 1380, and that's very bullish. In my opinion, you got to break above this trend line here, which is around that 1420 area, to confirm a renewed uptrend here. But right now we're kind of in no man's land, but nonetheless there are a lot of underlying fundamentals that are suggesting that we are in the first inning of a massive run, positive bullish run in the PM space. So now the high yield ETF is similar to the equity indices. It has broken down from its wedge. We had negative divergence with higher highs, but momentum wasn't making higher highs, and it looks like we're going to make a move lower in high yield and junk credit. Question is how low we go. I don't know. I mean, at this point, I don't have a strong conviction. I think the move is lower. The question is how low, and whether there's going to be a bounce. And my hunch is the bounce starts around 34.75 area, and does it bounce towards 35.25, find resistance and move lower, or does it expand this range and begin a renewed uptrend? We'll see. Here's the housing index. Another bearish wedge breakdown below this trend line here, but it's still above the 50 RSI, so you need to take that out for this move to continue lower with any energy. Crude oil here. Crude oil has not been able to break above the 50, but the first attempt is not necessarily the one that works. So I'm watching this closely. It still may attempt another move higher towards that 60 level. We're in this bearish wedge. If we cannot break this, and if we go lower, then I can see us moving back to 45, possibly as low as 40 in crude oil. Here's the NASDAQ, another example of a bearish wedge. Still got the 50-week moving average below it acting as support, but here you've got this negative trend line consecutive lower highs. That's a very negative development. If it closes the week below the 50, that would not be good. NASDAQ equal weighted, just for a different perspective. This last run-up had done a really great job in building up the bottom part of these indices, and most of the underlying stocks had done really well. But notice it could not break out above this breakdown point, and now we're rolling over. So not a good sign there. Russell 2000, same thing, negative trend line breakdown. You've got the S&P 500 equal weighted breakdown, retest, kiss this from the downside. This breakdown. So overall, I'm seeing a lot of reason to think that this particular move has ended that we've seen since December, and my hunch is eventually, not in a straight downward line, but I think eventually we're going to see new lows, possibly below that 2300 area on the S&P. So stay tuned and be careful if you're long. Here's the semiconductors, the one index that's done exceptionally well, but this too is breaking down. Total stock market, this is one I posted over the weekend. Look at this negative, or rather inverse head and shoulders. Again, bearish wedge, and in the downtrend here, keep an eye on this 50 RSI level. Here are the transports, same thing, bearish wedge breakdown. The U.S. dollar, I pointed out, is actually starting to show quite a bit of strength here. So it very well may break out, and if it does, it might make a run towards that $100 zone right about here, and kind of further create this inverse head and shoulders that may take over several years to play out. But until now, it's creating negative divergence. But this particular move seems pretty strong. PPO is curling to break out above zero, so I'm very interested to see what happens there. You've got volatility here. Look at this bullish wedge here. We finally broke out. I think we're going to see a lot of volatility in the next 3 to 6 months. So this is a good area to speculate if that's your style. Wilshire 5000, same story, and here's the world index minus US. So obviously you had emerging markets had done well over the last couple of months. They've outperformed the S&P, but this is a very, very strong trend line. And as soon as we hit it, we reverse lower. We close the week below the 50 as well as a 200-week moving average. So if we can't recapture that, I can see us moving all the way back towards 1500, which would be the lows of 2016. I obviously don't think this happens right away. There's going to be a lot of zigzag, a lot of confusion, a lot of headaches. But overall, I think the markets have a negative slant to them at this point. And I did want to quickly mention, for those of you who like my work and want to support my work, I'm going to be launching a premium service, and that's going to launch around July. So if you want to be a part of it, we've got about 73 slots available. From 100. So if you want to be part of it, shoot me a note at dave@moniology.com, and I look forward to having you a part of our group here. So thank you and have a great week.